Holy freaking crap, guys. This is why I say I never trade during earnings or through earnings, holding stocks or buying calls or puts through earnings, because things like this could happen. Look at this. Foot Locker stock is now down 28%, down over $11 per share after they reported earnings this morning. And their stock's currently at $30 when just yesterday it was over $41 per share. And a couple months ago, it was at $47 per share. So I want to break down Foot Locker's earnings very quickly in this video. We'll break down the charts, do all that good stuff. So if y'all find value, hit that like button, subscribe, and don't forget to get up to 15 stocks from Moomoo and 12 stocks from Webull. Link down below, guys. We'll talk more about that later. And now, cheers. Let's talk about Foot Locker. So yeah, down roughly 27% right now, completely in free fall mode at a fresh multi-month low. We're taking out the moving averages, which we were under the moving averages already. Now it's just way worse. It's a falling knife, the whole 9 yards, right? This is a freaking disaster when it comes to the charts, guys. So before we dive into the actual earnings release, let me read the headline numbers here. It looks like they did adjusted EPS of 70 cents, which missed the 81 cents expected. So they missed on EPS, and to make it worse, they missed on revenue, guys. You guessed it, 1.93 billion versus 1.99 billion estimated. So missed EPS and they missed on revenue, and I believe their guidance wasn't good. I was reading that, and it looks like here they see 2023 comparable sales change down 7.9 to 9%, and they see 2023 sales down 6.5 to 8%. That's not good. And I believe year over year, excuse me, guys, their revenue number is not good at all. We'll talk about that in a second as we jump into the actual earnings release. And it looks like here they lowered their 2023 adjusted EPS guidance from $3.35 to $3.65, now to $2 to $2.25. Oh my God, that's going to make me jump out of my seat, guys. That is awful. And it looks like here, wow, I mean, geez, same store sales again down 9.1% when the estimate was for a decline of 7.7%. Oof. And to make things even worse, guys, it looks like they lowered their 2023 gross margin guidance from 30.8 to 31% to now 28.6 to 28.8%. So these numbers are hurting all throughout, the board, all across the board, from EPS to revenue to guidance, same store sales. It is not looking good. Excuse me, guys, my throat's freaking messed up today. It is not looking good at all right now for Foot Locker. So let me actually transition over here to Safari so we can actually get a little more insight on some of the key financial metrics. So yeah, let's talk about this, guys. So total sales, if I zoom in a little bit, you guys can see decreased 11.4%, and comparable store sales decreased 9.1%. Like we mentioned, that was a number we mentioned a little bit ago. EPS of 38 cents and non-GAAP EPS of 70 cents, and they lowered their 2023 sales and earnings guidance, which is not good at all. And it looks like here they just announced a new CFO, announced his retail industry veteran Mike Bond as CFO. Okay, I have to look deeper into Mike Bond. And full disclosure, guys, I'm not a shareholder of Foot Locker, but I do track the company, not too close, but I like to keep an eye on it, right? And now it's down a lot from all-time highs. I think all-time highs were over $60. Now we're at 30, so we're down probably over 50% on Foot Locker over the past couple of years. Not a good sign at all. So looking at this, guys, it looks like they're blaming the lower comparable store sales, or the decrease, in comparable store sales by 9.1%. They're blaming it on macroeconomic headwinds, which I guess makes sense, including lower income tax refunds in the United States, as well as the changing vendor mix and their repositioning of Champs Sports, which you guys know they're involved with Champs Sports, right? And like we said, total sales decreased by 11.4%, yada, yada, yada. We talked about that already. And gross margin declined by 400 basis points from the prior year, driven by a combination of higher markdowns compared to historically low levels in the prior year, and occupancy deleverage, as well as an increase in theft-related shrink, which you guys, I'm not sure sure if you saw, but in Target's earnings from the last couple of days, or when were they, on Wednesday? Either way, when they reported, they said that they lost $500 million to almost $1 billion, I believe, in that range, due to theft. I mean, that is just insane. I mean, I'm sure you guys have seen these videos online surfacing on Instagram, Twitter, of people just running in and stealing a bunch of stuff. I mean, that's going on every single day right now across the country, right? People have bags, they run in and they steal a bunch of crap, they leave. That's causing these Targets to lose a ton of money, and that's what we're seeing with Foot Locker, right? People are running into Foot Locker, they're probably doing the same thing, and of course their shoes are in the back, so I mean, they're not probably going through that door and actually going to get the shoes. Only the shoes on display are there, which, I mean, I guess you could steal one shoe. I mean, who would do that? I mean, I guess people would do that, but I'm assuming they're stealing more, like the sweatsuits or shorts or, the accessories that they sell at Foot Lockers. But either way, people are stealing a lot at Foot Locker, and they're doing it at Target, Walmart, you name it, across all these retail, locations throughout the United States. This is happening right now, and it's a problem. I mean, it's showing up in these earnings 100%, and, this problem might not stop anytime soon. I mean, I think in places like California, I think it's not legal, but it's decriminalized or something like that to steal up to $900 worth of goods, which is just insane. I mean, you guys have seen the videos. Like I said, people just walk in and the cashier, people that work there are just watching them, because why would they stop them, right? I mean, why would you put yourself in harm's way for Walmart or whatever? I get their perspective for not stopping them. I probably wouldn't either if I was working there. But either way, the system is just so freaking messed up right now. We're not going to get into that in this video, but there's a lot going on, and that's showing up in these numbers on Foot Locker, and their gross margin was 100% affected by that. I mean, you guys can see again, it declined by 400 basis points, and coming down a little bit more, let's see here. Net income decreased to $36 million as compared with $133 million in the first quarter of fiscal 2022. That's awful. And EPS decreased to 38 cents per share versus the $1.37 in the first quarter of 2022. Not good, guys. So let me actually see if I could pull up the balance sheet, then we'll wrap up the video. Alrighty, here it is. So we can see their total current assets right now are right around, where are we here? Right around $2.4 billion. You guys can see $313 million in cash and cash equivalents, roughly $1.75 billion in what is that, merchandise and inventory. So inventory, right, and other current assets, roughly $385 billion or $1 million, right? I can't even get the millions and billions correct today, guys. Coming down here a little bit more, let me see what current liabilities are looking like. So current liabilities right now are right around, $1.5 billion. All right, not bad. So it looks like their current ratio is what, for 2.4 over 1.5, so it's pretty good, right? Roughly a 1.34 current ratio, which is good. I like seeing that on a balance sheet. Decent amount of cash there, and it looks like it's not the best, but not the worst. And we're not going to dive too deep into the cash flows or the income statement or anything like that. But overall, guys, look, they're struggling right now, declining in all metrics, and their chart is just awful. And the fact that they're guiding for more pain to come, essentially, with worse EPS guidance, margins are probably going to shrink even more. This stock is really feeling it right now, and to be honest, guys, I'm not looking to touch it anytime soon. Maybe if it starts getting into the 20s, maybe I'd start considering it, but at this point, it's a falling knife. And typically when I see a huge dump after earnings, I like giving it a little bit of time, let the dust settle, and make a decision from there. But right now it's down 27%, right by the lows from September, October, November of last year. You guys can see. So if we do take those lows out, $29-30, we're probably going lower, and we could see potentially a move towards low mid-20s, which is where it was, you guys can see, back in July of 2022. So about a year ago, we were at 23 bucks, guys. Don't be surprised if we start going back down there, and that could be a point where I would consider it a decent move. Maybe we'll do a deeper dive into it and break it down maybe in the future if it does get get a little bit lower. So if y'all found value in this video, hit that like button. Feel free to subscribe, and don't forget to get up to 15 stocks for Moomoo, guys. It is free money. Once you guys open up an account using that link down below, or by going to stassurfest.com/Moomoo, you get 1 free share of stock right off the bat. And once you fund your account with at least $100, you get 4 more stocks totaling 5 stocks. And fund your account with at least $1,000, you get 10 more stocks totaling 15 free stocks. So if you guys want to help out the channel and you want some free money, use that Moomoo link down below. Check out the Patreon as well, and you might as well get 12 more stocks from Webull. And with that being said, I'll catch you guys in the next one. Peace out.